Hey guys, wanted to let you know what the heck is going on in the mortgage industry these days. There is a lot of confusion out there, and here's kind of where it goes down to capacity and liquidity. Let me tell you what the heck I'm talking about. So, when last Tuesday, Wednesday, Thursday, Friday, the mortgage market lost 484 basis points. Monday, we had rates in the 3s. By Friday, rates were in the 5s. What happened? The Fed lowered their Fed rate. Why aren't my rates going down? Here's why. The Fed rate, which ties into the prime rate, is only applicable to credit cards, auto loans, personal loans, payroll loans, home equity lines of credit if you have one of those. But if you're out there buying a house, conventional FHA financing has nothing to do with that. That's column A. Column B would be mortgage-backed securities and treasuries. That's what determines mortgage rates. So if you're wondering, why isn't my mortgage rate 0? Or why hasn't it dropped by a full percent? That's why. Apples and bananas, we're not talking about the same thing. So we had a liquidity issue. There was a run on the banks. A run on the banks means that everybody went to pull their money out of their bank because it was the end of the world apparently because of the coronavirus. So there was an overreaction. People took their money out. Banks didn't have enough cash. They're required to have a certain amount of cash, and they didn't have it. So they thought, gosh, we'll just sell our mortgage-backed securities and treasuries. But everybody was selling, nobody was buying. So the Fed comes in and says, we will buy all of that stuff to the tune of, well, started at $1 trillion, $700 billion, and it started today, Monday, the 16th of March, between 40 and 60 billion dollars. So the run on the banks created a liquidity issue, so all of this stuff ultimately had to be sold to the Fed because there was no other buyer. That fed the liquidity into the market. So mortgage rates are going to get better over the next couple of weeks. They're quick to take away, not quick to give. So you're not going to see an immediate drop in mortgage rates back down into the 3s, but over the next 2 to 3 weeks you will see that happen. The Fed rate has nothing to do with mortgages. Your mortgage is not going to be 0 or 1 full point lower just because the Fed dropped it by 100 basis points, which is 1%. So that created the liquidity issue. Capacity, when the rates got down super duper low, lower than we've seen ever, all sorts of refinances came into the doors, which means that lenders didn't have the human resources to take care of all of those loans. I'll put it in perspective and leave you with this. There are approximately $11 trillion in mortgages out there. Those are loans that have funded and people are making their payments. Great. So half of them, roughly half of them, are eligible for refinances. That's $5 to $6 trillion in loans. Well, over the last month or two, about $3 trillion came in over 2 months, whereas we might be able to do that in a year. It flooded everybody, all lenders. They couldn't handle the volume, and rates crept up even though they didn't have to. Frustrating, I know, I'm in the industry, but that's what happens. So lenders control the flow of loans many times by jacking up rates, even though they shouldn't have. So between the liquidity that was caused and the sell-off, the run off to the banks from people, we had major cleanups all of last week. It's gotten better today. It's going to continue to get better, but please make sure you're talking to a lender, a loan officer who knows about this and can guide you through these complicated times, and not just quoting you a rate and a payment, because there's a lot more to it than that, for sure. So I hope that helps you understand. The Fed rate has nothing to do with mortgages. They are two different things, and so mortgage rates will come back down, but they weren't going to come down to 0 just because of what the Fed did.